Hello, everyone, and welcome back to another episode of English for Success.
Hi, everyone. I am Michelle, and joining me, as always, is my co-host, Michael.
Great to be here, Michelle. Today, we have a really practical topic for our listeners.
Yes, we do. Today, we are talking about Q1 financial planning vocabulary.
This is perfect for anyone who works in business, finance, or just wants to understand money talk in English.
Exactly. Whether you work in an office or run your own business, you will hear these words all the time.
So, Michelle, let's start with the basics. What does Q1 even mean?
Great question. Q1 stands for quarter one, or first quarter.
Right. A quarter is 1/4 of something.
Exactly. A year has 12 months, so each quarter has 3 months.
Q1 is January, February, and March.
Q2 is April, May, and June.
Q3 is July, August, and September.
And Q4 is October, November, and December.
So when someone says Q1, they mean the first 3 months of the year.
Correct. Companies often plan and report their finances by quarter.
That makes sense. Now, what about the term fiscal year?
A fiscal year is a 12-month period used for financial planning and reporting.
Is it always the same as a regular calendar year?
Not always. Some companies have a fiscal year that starts in a different month.
Can you give an example?
Sure, some companies have a fiscal year that starts in April and ends in March.
So their Q1 would be April, May, and June instead.
Exactly. It depends on the company.
That is good to know. Now let's move on to some key vocabulary.
Let's start with the word budget.
A budget is a plan for how to spend money.
Right. It shows how much money you expect to have and how you will use it.
Companies create budgets at the beginning of the year.
They decide how much to spend on different things.
For example, they might budget money for salaries, marketing, and equipment.
Here's a sentence. The marketing team needs to submit their Q1 budget by Friday.
Another example, we went over budget last quarter.
That means they spent more money than they planned.
What about the opposite?
If you spend less than planned, you are under budget.
We finished the project under budget. That's a good thing.
Definitely. Managers love hearing that.
Now let's talk about revenue.
Revenue is the money a company earns from selling products or services.
It's also called income or sales.
Before you subtract any costs, the money coming in is your revenue.
Can you use it in a sentence?
Our Q1 revenue was higher than expected.
Another example, the company needs to increase revenue this quarter.
Revenue is very important because it shows if customers are buying your products.
Now, the opposite of revenue is expenses, right?
Well, not exactly the opposite, but expenses are the costs of running a business.
Expenses are the money going out.
Yes. Examples of expenses include rent, salaries, utilities, and supplies.
So revenue is money in and expenses are money out.
Exactly. You want your revenue to be higher than your expenses.
That brings us to profit and loss.
Profit is the money left after you subtract expenses from revenue.
If you earn more than you spend, you have a profit.
If you spend more than you earn, you have a loss.
Companies want to make a profit.
Here's a sentence. The company reported a profit of $2 million in Q1.
And here's another. Unfortunately, we had a loss last quarter due to high expenses.
The word profit can also be used as an adjective.
Yes, we say a profitable business or a profitable quarter.
That means the business or quarter made money.
Great. Now let's talk about forecasting.
A forecast is a prediction about the future. In finance, a forecast predicts future income, expenses, or sales.
Companies use data from the past to make forecasts.
For example, if sales grew 10% last year, you might forecast similar growth this year.
Here's a sentence. The Q1 forecast shows strong sales growth.
Another example. Our forecast was too optimistic.
That means they predicted better results than what actually happened.
A similar word is projection.
Yes, a projection is also a prediction or estimate about the future.
The sales projections for next quarter look promising.
Forecast and projection are often used interchangeably.
That means you can use either word in most situations.
Good to know. Now let's discuss targets and goals.
A target is a specific result you are trying to achieve.
It's usually a number or amount.
For example, our sales target for Q1 is $500,000.
A goal is similar but can be broader.
Goals can be general, like improve customer satisfaction.
Targets are more specific, like increase customer satisfaction scores by 15%.
Here's a sentence using both. Our goal is to grow the business, and our target is 20% growth.
I like that example. It shows the difference clearly.
Thank you, Michael. Now let's move on to cash flow.
Cash flow is very important for any business.
If more money comes in than goes out, you have positive cash flow.
If more money goes out than comes in, you have negative cash flow.
Here is a sentence. The company is struggling with cash flow problems.
That means they do not have enough money to pay their bills on time.
Even profitable companies can have cash flow problems.
That is true. You might have made sales, but if customers have not paid yet, you do not have the cash.
Very important concept. Now let's talk about assets and liabilities.
Assets are things a company owns that have value.
Examples include cash, equipment, buildings, and inventory.
Inventory means the products a company has ready to sell.
Assets are listed on a company's balance sheet.
A balance sheet is a financial document that shows what a company owns and owes.
That brings us to liabilities.
Liabilities are debts or things a company owes.
Examples include loans, unpaid bills, and mortgages.
A mortgage is a loan used to buy property.
So assets are what you own and liabilities are what you owe.
Exactly. Here is a sentence. The company has more assets than liabilities, which is a healthy sign.
Another example. We need to reduce our liabilities this quarter.
The balance sheet shows both assets and liabilities.
It gives a picture of the company's financial health.
Another important document is the income statement.
What does an income statement show?
It shows revenue, expenses, and profit or loss over a period of time.
So it tells you if the company made money or lost money.
Exactly. The income statement is also called a profit and loss statement.
Some people just call it the P&L.
That is common in business. The P&L for Q1 looks good.
Now let's talk about some abbreviations.
Great idea. Financial English has many abbreviations.
Let's start with ROI.
ROI stands for Return on Investment.
It measures how much profit you make compared to how much you spent.
If you invest $100 and make $120 back, your ROI is 20%.
Companies use ROI to decide if an investment is worth it.
Here's a sentence. What is the expected ROI on this project?
Another example. The marketing campaign had a high ROI.
That means the campaign made a lot of money compared to what it cost.
Now let's talk about KPI.
KPI stands for Key Performance Indicator.
A KPI is a measurement that shows how well something is performing.
Companies choose specific KPIs to track their success.
For example, a KPI might be the number of new customers per month.
Or it might be the average time to complete a project.
Here is a sentence. Customer satisfaction is one of our most important KPIs.
Another example. We need to review our Q1 KPIs in the meeting.
KPIs help managers understand if they are meeting their goals.
They are very important for planning and decision-making.
Now let's talk about something else.
We should also cover the term YOY.
YOY stands for year over year.
It compares data from one year to the same period in the previous year.
For example, sales are up 15% YOY.
That means sales are 15% higher than the same time last year.
Year-over-year comparisons are very common in financial reports.
There's also QOQ.
QOQ stands for quarter over quarter.
It compares data from one quarter to the previous quarter.
For example, revenue grew 5% QOQ.
That means revenue grew 5% compared to last quarter.
Both YOY and QOQ help you see trends over time.
Now let's talk about variance.
Variance is the difference between what you expected and what actually happened.
If you budgeted $10,000 but spent $12,000, the variance is $2,000.
That would be a negative variance because you spent more than planned.
If you spent only $8,000, the variance would be positive.
Here's a sentence. The Q1 variance report shows we overspent on marketing.
Another example. Please explain the variance in the sales numbers.
Understanding variance helps companies improve their planning.
Now let's discuss allocation.
Allocation means dividing or distributing something.
In finance, it often refers to dividing money among different areas.
For example, the budget allocation for Q1 gives 40% to research and development.
Another example, we need to decide on the allocation of funds for the new project.
Allocating resources wisely is an important part of financial planning.
Speaking of spending, let's talk about overhead.
Overhead refers to ongoing business expenses.
These are costs that are not directly related to making a product.
Examples include rent, utilities, insurance, and administrative salaries.
Even if you don't sell anything, you still have to pay overhead costs.
Here is a sentence. Our overhead costs are too high.
Another example, we need to find a way to reduce overhead.
Overhead is also called operating expenses or fixed costs. Now let's talk about net and gross.
These two words are very important in finance.
Gross means the total amount before any deductions.
Net means the amount remaining after deductions.
For example, gross income is your total income before taxes.
Net income is what you have left after paying taxes.
Here is a sentence. My gross salary is $50,000, but my net salary is $40,000 after taxes.
In business, gross profit is revenue minus the cost of goods sold.
Net profit is what remains after all expenses, including overhead.
So gross is the bigger number and net is the smaller number after subtracting things.
Exactly. Remember, net is what you actually keep.
Another important term is margin.
Margin refers to the difference between the cost and the selling price.
It is often expressed as a percentage.
A profit margin shows how much profit you make on each sale.
For example, if a product costs $60 to make and sells for $100, the margin is $40 or 40%.
Here is a sentence. We need to improve our profit margins.
Another example, the margin on this product is too low.
A higher margin means more profit per sale.
Companies always want to maintain or increase their margins.
Now let's discuss benchmarks.
A benchmark is a standard or point of reference for comparison.
Companies compare their performance to benchmarks.
A benchmark could be an industry average or a competitor's performance.
Here is a sentence. Our sales numbers are above the industry benchmark.
Another example, we use last year's Q1 as a benchmark for this year.
Benchmarks help companies understand if they are doing well or need to improve.
Finally, let's talk about stakeholders.
A stakeholder is anyone who has an interest in a company's success.
This includes investors, employees, customers, and suppliers.
Stakeholders want to know about the company's financial health.
Here is a sentence. We need to share the Q1 results with all stakeholders.
Another example, our stakeholders are concerned about the declining profits.
Keeping stakeholders informed is an important part of business.
Now let's do a quick review of the vocabulary we covered.
Q1 means the first quarter, which is January, February, and March.
Fiscal year is a 12-month period for financial planning.
Budget is a plan for spending money.
Revenue is money earned from sales.
Expenses are costs of running a business.
Profit is money left after expenses.
Loss is when expenses are greater than revenue.
Forecast is a prediction about future finances.
Target is a specific goal you want to achieve.
Cash flow is money moving in and out of a business.
Assets are things a company owns.
Liabilities are debts a company owes.
ROI is return on investment.
KPI is key performance indicator.
YOY is year over year.
QOQ is quarter over quarter.
Variance is the difference between expected and actual results.
Allocation is how money is divided among different areas.
Overhead is ongoing operating costs.
Gross is total before deductions.
Net is what remains after deductions.
Margin is the difference between cost and selling price.
Benchmark is a standard for comparison.
Stakeholder is anyone with an interest in the company.
That was a lot of vocabulary, Michael.
It was, but these words are essential for anyone working in business.
Let's do a quick practice exercise for our listeners.
Great idea. I will describe something and listeners can think of the word.
Ready, everyone? Here we go.
Number 1. This is the money a company earns from selling products. What is it called?
The answer is revenue.
Number 2. This shows what a company owns and what it owes. What document is this?
The answer is a balance sheet.
Number 3. This abbreviation compares this year's numbers to last year's numbers.
The answer is YOY, or year over year.
Number 4. This is the money left after you pay all expenses.
The answer is net profit, or just profit.
Number 5. This is a standard you compare your performance against.
The answer is a benchmark.
Great job, everyone.
Before we finish, let's hear a sample conversation using this vocabulary.
Good idea. Let's imagine a meeting about Q1 financial planning.
I will be the manager, and you can be the financial analyst.
Sounds good. Let's begin.
Good morning. Thank you for preparing the Q1 financial review.
Good morning. Yes, I have all the numbers ready. Our Q1 revenue was $3.2 million.
How does that compare to our target?
We exceeded our target by 8%. The target was $3 million.
That is great news. What about expenses?
Expenses were slightly higher than budgeted. We had a variance of $50,000.
What caused the variance?
Mostly overhead costs. Utility prices increased this quarter.
I see. And what is our net profit for Q1?
Net profit is $450,000. Our profit margin is about 14%.
How does that compare YOY?
It is up 12% compared to Q1 last year.
Excellent. What is your forecast for Q2?
Based on current trends, I project revenue of $3.5 million.
Good. Let's allocate additional funds to marketing to support that growth.
I agree. I will update the budget allocation and share it with all stakeholders.
Please also include our key KPIs in the next report.
Absolutely. I will use our Q1 results as a benchmark for Q2 goals.
Perfect. Thank you for the thorough analysis.
You're welcome. I will send the full report by end of day.
Great. Meeting adjourned.
And that concludes our sample conversation.
I hope our listeners could hear how naturally these words are used in business.
The more you practice, the more comfortable you will become.
Try using these words in your own workplace.
Read financial news in English to see these words in context.
You can also listen to business podcasts to hear how people use this vocabulary.
Do not worry if you don't remember everything immediately.
Learning takes time. Review this lesson as many times as you need.
Write down the words that are new to you.
Try to create your own sentences using each word.
That will help you remember the vocabulary.
Well, that brings us to the end of today's lesson.
We covered a lot of important financial planning vocabulary.
Thank you for listening to English for Success.
We hope you found this episode helpful.
Practice your new vocabulary and join us next time for another English lesson.
Until then, take care, everyone.
Goodbye and happy learning.
Goodbye.